Hello all. Let's talk about bank reconciliations. All businesses have checking accounts with a financial institution. Banks are used to process deposits, collect payments, cash checks, and transfer funds electronically. Today's banks keep track of their business accounts and provide activity reports daily through online banking and monthly through bank statements. Businesses match the bank statements against their cash account in the general ledger to determine the differences between the two and identify why those differences exist. The two balances rarely match because of timing differences, omissions, errors, and even fraudulent transactions. Before we get into how to prepare a bank reconciliation, let's discuss the what, the why, and the when of bank reconciliations. First of all, what? Bank reconciliations are worksheets designed to ensure the accuracy of the company's cash position by comparing and reconciling the differences between the bank statement balance and the cash balance from the company's general ledger. Why? Well, the goal of bank reconciliation is to protect company cash and ensure the accuracy of the company's cash position. The reconciliation process identifies all differences between the bank statement and the company cash account and allows for the update of the cash account so that the true cash balance can be determined. When is this done? Many companies have online banking and will reconcile their account daily, while others will wait for monthly statements to do a monthly reconciliation. The bank reconciliation process includes 3 steps. Step 1 calculates the bank balance per reconciliation. Step 2 calculates the company cash balance per reconciliation. Step 3 updates the company's cash account by journalizing and posting the reconciling items for the company. It is important for you to realize that the reconciling items for the bank statement are not journalized on the company's books. Only those adjustments needed for the company's books are journalized and posted to the cash account in the general ledger. Once the adjustments are journalized and posted to the cash account, the company's cash account will equal the bank balance per reconciliation. That's the basics. Now that you understand the concepts, let's do a problem. If you look at the screen, you'll see that Oscar's Red Carpet Store maintains a checking account with Academy Bank. Oscar sells carpets each day, but makes bank deposits only once a week. Information from the company's cash ledger for the month of February include deposits, checks, and a balance. As can be seen, our cash account's beginning balance on February 1st was $6,800. During the month of February, Oscar's Red Carpet Store received $13,900 in cash payments. During the month of February, they also made payments by writing checks totaling $12,600. So the February 28th unadjusted balance is $8,100. We take the beginning balance of $6,800, add receipts of $13,900, subtract disbursements of $12,600 to get a cash account balance on February 28th of $8,100. Now let's look at steps A through I and do a bank reconciliation for Oscar's Red Carpet Store. Letter A says the ending cash balance recorded in the bank statement was $13,145. So our company received the bank statement. The bank statement states that we have $13,145. Our general ledger, on the other hand, says our cash balance is $8,100. The difference between the two is $5,045. That difference needs to be explained, and that explanation is done through a bank reconciliation. So what we do at this point is begin by creating a template for the bank reconciliation. The left side of the template includes the bank statement balance and all adjustments needed to get to a final or reconciled cash amount. The typical adjustments needed on the bank side include deposits outstanding, checks outstanding, and errors. The right side of the template includes the company's cash account ledger balance and all adjustments needed to get a final or reconciled cash balance. The typical adjustments include customer payments made directly to the bank, interest earned, service charges, electronic funds transfer transactions, and errors. For our reconciliation at this point, we have on the bank statement side of the template a balance before reconciliation of $13,145. On the right side of the template, we have a company's cash ledger account balance before reconciliation of $8,100. Now let's look at letter B. Letter B says cash receipts from 2/26 through 2/28 are outstanding, and they total $1,600. The $1,600 of cash receipts are referred to as deposits outstanding because they are company receipts like cash and checks from customers that have been recorded by the company, but the amount will appear on its bank statement at a later date. So at this point, the bank is not aware of those deposits. This means that the bank balance will be less than the company's amount of cash, and as a result, deposit outstandings must always be added to the bank statement balance. So let's add the $1,600 to the left side of the template. Letter C says that checks outstanding are check number 325 for $200 and check number 327 for $1,900. During the month, checks 321 through 327 were written. These two checks are referred to as checks outstanding. Checks outstanding are checks that a company has issued and recorded in its general ledger account, but the checks have not yet cleared the bank account on which it was drawn. This means that the bank balance will be greater than the company's amount of cash, and as a result, checks outstanding must always be deducted from the bank statement balance. So let's enter the two checks outstanding with their balances on the left side of the template. We'll enter them as negative amounts to make certain that people understand that they are being subtracted. Letter D says that the deposit on 2/11 includes a customer's check that did not clear, an NSF check for $200. NSF checks are not sufficient funds checks. They are also referred to as bounce checks because they are customer payments that we have deposited with our bank that bounce back to us because our customer did not have the funds available to cover the check. Because our company was not aware of the NSF check until notified by the bank, we must adjust our cash account by reducing our cash balance. NSF checks are always entered on the right side of the template as a negative amount. In this case, it would be $200. Once we are aware that a customer check is bounced, we will notify that customer and request payment. Letter E says that check 323 was written for $2,800 for advertising in February. The bank properly recorded the check for this amount. But on our books, we recorded the amount for $2,500. The $300 difference is an example of an error. The error was made by the company because the company incorrectly recorded a $2,800 check as $2,500. Errors can be made by either the bank or the company. Bank errors can result in the bank statement balance being greater or less than the company's cash position. Typical errors on the bank side include posting the amount to the wrong customer's account, making an entry twice, failing to account for a transaction, transposing amounts, and recording incorrect amounts. For instance, the bank may incorrectly record the deposit or withdrawal of another customer's account into the company's bank account. Likewise, a deposit or withdrawal may be erroneously recorded twice by the bank. These types of discrepancies would cause the balance shown in the bank statement to either be higher or lower than the cash account balance, depending on the nature of the error. Bank errors must always be reported to and corrected by the bank. Bank errors do not affect the company's books. On the other hand, company errors can result in the cash account being greater or less than the bank statement balance. In this case, we have a company error. Typical company errors include recording incorrect amounts, posting to the wrong account, and failing to account for a transaction. This error will cause the balance shown in the cash account to be $300 higher than the bank statement balance, and as a result must be subtracted from the company's side of the template. When you have a company error, the company errors are always affecting the company's books. They always must be corrected. Letter F shows that an automatic withdrawal for Oscar's February rent was made on February 4th for $1,100. Automatic payments are also referred to as electronic funds transfer payments, or EFTs. Our company has entered into an agreement that permits our landlord to withdraw funds from our checking account monthly for rent payments. In this case, the $1,100 payment shown on the bank statement must be subtracted from the company's cash account balance. Letter G states that interest earned on Oscar's checking account for the month was $20. Bank checking accounts may or may not pay interest. In Oscar's case, they apparently do, and he's earned $20. That $20 is already part of the bank statement. It needs to be included in Oscar's checking account balance. So interest earned on the company's checking account is always added to the right side or the company's side of the reconciliation template. Letter H states that in January, one of Oscar's suppliers, Titanic Fabrics, borrowed $6,000 from Oscar. On February 24th, Titanic paid Oscar. They paid Oscar $6,250, which represented the $6,000 borrowed, plus $250 of interest for the period. The payment was made directly to Academy Bank. It is not unusual for a company to enter into an agreement with a customer or vendor to make payments directly to the company's bank. Payments may be made either by check or electronically. In these cases, the bank statement cash balance will be higher than the company's cash account balance until the company adds the amount received to its cash account. The receipts of customer payments, whether by check or electronically, are always added to the company's side of the reconciliation template. Letter I states that the Academy Bank charged service fees to Oscar for the month, $125. Banks charge their customers service fees for processing deposits and cashing checks, as well as other financial services. The service fee is always an expense from the company's perspective. So when entering the service fee onto the bank reconciliation, we will enter it on the company's cash account side as a negative amount. For this problem, it will be a negative $125. At this point, the hard work has been done. The difference has been accounted for, and it's time to complete the bank reconciliation and determine our true cash account balance. We start with the bank statement side of the template. Adding the deposits outstanding and subtracting the checks outstanding will give us our total reconciling items of a negative $500. Subtracting the $500 from the bank balance before reconciliation of $13,145 gives us the bank statement balance after reconciliation of $12,645. The $12,645 should be our true cash balance. We will confirm this by moving to the company's cash account, adding the note received, interest earned on the note and on the bank account, then subtracting the NSF check, rent payment, service fee, and then adjusting for the check error will give us the total reconciling items of $4,545. Adding the $4,545 to the cash balance before reconciliation of $8,100 gives us the company's balance after reconciliation of $12,645. We have reconciled our differences and confirmed the true cash balance to be $12,645. The final step requires that we journalize the reconciling items and post the amounts to the company's cash account in the general ledger. We can do this with two compound entries. Unlike simple entries that have a single debit and a single credit, compound entries have multiple debits, multiple credits, or both. For our problem, we will enter February 28th as the entry date. Our first entry will have a debit to cash for $6,270. We will debit cash because cash is an asset that is increasing, and assets increase on the debit side. We will credit notes receivable for $6,000 and interest revenue for $270. Notes receivable is credited because notes receivable is an asset that is decreasing due to our customers' payment to us. Assets decrease on the credit side. We will also credit interest revenue for $270 to record the interest earned of $250 on the note and $20 interest earned on the bank account balance. Revenue accounts increase on the credit side. Our second entry records the cash decreases that have taken place. We will debit accounts receivable for the $200 NSF check. We debit accounts receivable to record the amount that our customer still owes us due to bouncing his check payment, assets increase on the debit side. We will debit rent expense for $1,100 to record the electronic rent payment, service fee expense for $125 for bank service charges for the period, and advertising expense for $300 to correct our error made on check 323. Recording the advertising bill payment at $2,500 instead of $2,800 resulted in an understatement of advertising expense by $300. Because expenses increase on the debit side, these entries have all been debited. To complete the entry, we credit cash for the total amount of the debit amounts of $1,725. Once the journal entries are posted to the accounts in the general ledger, the balance for the accounts is updated and accurate. As you can see, the cash account amount will now equal the balance after the reconciliation of $12,645. Well, that's it. Hopefully you have a better understanding of the purpose and preparation of bank reconciliations. Thank you for taking the time to view this video. Good luck.